Okay, hi everyone. This is going to be the third lecture for chapter 20. We're talking about allocation here of profit or loss to the partners in a partnership. Now, historically, we've discussed this in a very simple way. Maybe it's like something pro rata. There's four partners, you make $100, you split it four ways, the profit or loss. That's one way you could do it, right? You could also do it by virtue of how much you contribute to the partnership. Those with greater contributions would receive greater percentage of ownership in the business and greater percentage of profit allocated to them. And the idea with this is partnership law is flexible, so there's not like one set way you overall have to do it. You can pick and choose how you want to do it. Generally, as long as there's a legitimate business reason for doing so and it's not for just pure tax avoidance. This whole idea is called special allocation. So basically, you can specially allocate how you want to create these profit or loss sharing ratios. Now, a lot of times in practice, you may actually have to dig into a partnership agreement like the formal document that they did when they started the business and look and see how they set these up for purposes of special allocations. So what this also means is because there's not one exact way, it can be a little bit more work whenever you actually do the return, because you have to go and look and see what are the special allocations, how are they allocating profit or loss. Now, that's going to be the general rule, right? You can have special allocations for how you want to allocate profit or loss. The exceptions to this, the main exception is going to be whenever a partner contributes built-in gain property. And then the partnership later on sells that property. So let's say, for example, that you contribute a machine that has a $75 adjusted basis. Let's say that it has a fair market value of $125, right? So that's going to have a built-in gain there of $50, right? Let's then say that the partnership holds on to this property for 2 or 3 years and then it sells it, right, for $200. It went up in value, right? Well, we know the partnership's going to have a carryover inside basis of what your basis in the item was, namely $75. So the partnership will have sold it for $200. They're going to have an inside adjusted basis of $75. They're going to have a $125 gain. Now here's the deal, right? Whenever we have a built-in gain property from a partner that's contributed to the partnership, if and when the partnership then sells that property and realizes the built-in gain, the initial amount, the fundamental amount, the amount of the gain that was there when the partnership contributed it, or when the partner contributed the property, immediately has to be recognized by that partner. In other words, you can't just like special allocate the gain. The first part of it has to go to the partner who contributed it, and they recognize the amount of gain that was there at the time of contribution. So using our example, right, let's kind of back up here, right? A partner contributes the machine, has $75 basis, $125 fair market value, means $50 built-in gain at time of sale. Partnership later on sells it for $200, has an adjusted inside basis of $75, so has a $125 gain. So the bottom line here is the partnership has a $125 gain they have to distribute between the partners. Now the first 50 of that gain, right, that's going to have to specifically go to the partner who contributed the property up front. They have to kind of catch up and realize that built-in gain that they would have had at the time of contribution. Correspondingly, the remaining $75 of the $125 gain, you can then kind of allocate that according to the profit or loss sharing ratio. So that's the idea, right? If I contribute something with a $50 built-in gain, if and when the partnership sells that thing, the gain first has to come to me. And you can't specially allocate this. At least the $50 of the gain or any gain has to come to me. So let's look at 2020 here. So this is just showing here, they're trying to, in a partnership, say, hey, whenever we make money, we want the first 20% of the profit or losses to go to the partner 1 and 2. After this 20%, the remaining 80% of profits, we want to allocate by virtue of the capital and profits interests, 30, 40, and 30. Can we do this, right? Well, the idea here is going to be, yes, this is a partnership. You're allowed to have special allocations based off profit or loss. We're not dealing with any built-in gain property here. Next, it says, assume a partnership we have here, and we have a partner that contributes land that has a fair market value and an adjusted basis of 20. The partnership then sells it for 150 after contribution. So basically, they contribute this thing with a $30 or 130 built-in gain to it, and then the partnership immediately sells it. How do they allocate this gain, right? So the partnership itself is going to take a carryover basis of 20. They sell it for 150. Basically, they immediately take the 130 built-in gain on it. Well, with this, right, and as we've discussed, you can't allocate this based off profit and loss sharing ratios traditionally. That is to say, you have to immediately, up to the amount of gain the partner who contributed it, in this case 130, has to go to that partner. So in this case, right, all of the gain from this, the 130 gain, has to go to the partner who contributed it. Next one here, it says, suppose a partnership held land contributed for 1 year and then sold it on 3/1/19 for 180, resulting in a 160 gain. So, okay, same facts up here. We have, partner, they contribute property with a 130 built-in gain. And then the partnership waits a little bit. So this is like the first audible example I did. The partnership then sells it and has a gain later on. It looks like it appreciates in value, and the partnership has a $160 gain. How does this work? How do we allocate the profit or loss here? So the idea with it is, of the 160 gain at the partnership level, right? It's the total gain. 130 of it, highlighter out here, is going to go immediately to the partner who contributed it. You put it in, you get it out. Remember, we just talked about that. Then there's 30 left over, right? With that remaining 30 that's left over, we're going to allocate it based off our capital and profit interests. So in this case, just based off your ownership interests here. So 9, 12, and 9, right? So if you were to do 9 plus 12 plus 9, there you go. There's how the remaining 30 is allocated. So again, generally, like this example up here, you can allocate profit or loss however you want. It's called special allocations. However, when there's property that's transferred into the business that has a built-in gain, they put it in, they're gonna get it out. They're the first ones who have to have it allocated to them, right here. So some of this we've also talked about, right? Partnerships have to file a Form 1065 with the IRS by the 15th day of the third month after the year end. So generally 3/15. They have that automatic 6-month extension. We looked at ordinary business income and separately stated items on the return just to show how they flow through on that Schedule K. And then each partner is going to get a K1 showing their share of ownership, of the income or loss, how it's allocated to them. So we've talked so far about, outside basis, and we've kind of looked at it from just like an initial outside basis criterion. That is to say, if after I contribute property or services to a partnership, what is my outside basis? That is all we've asked so far and we've examined, just kind of an initial outside basis. However, right, once you establish your initial outside basis, as the partnership makes money or loses money, or you contribute more, or you take distributions, or you have more debt, or you have less debt, you have to modify and update your outside basis. In other words, the outside basis is not a static item for regard to a partnership interest. It's not as simple as you buy Apple stock for $300 forever and always, that's going to be your basis. With partnership law, we would say, yeah, maybe you bought your partnership for $300, but now after 1 year has passed, we have to update that basis in light of how much income you've been attributed, any new contributions you've made, any distributions that you've received, and any debt you've been allocated, right? So it's really a more dynamic concept, the idea of an outside basis. And the reason we update our outside basis, right, is really to avoid double taxation. So if you're going to tax me now in the current year on my percent of income from the partnership, that's great. But if I don't update my basis for that amount, that part of income attributable to me, if and when I then go sell my partnership interest, it will be like I got double taxed on it. So we will see that, in the examples here. But in general, right, I'm going to have this like base acronym: your beginning plus your additions minus your subtractions equals your ending. So this right here is showing us like our initial basis calculation, right? This is what we've looked at like the first PowerPoint. It's basically your cash plus your adjusted basis of property you gave, plus any liabilities the partner assumes, plus your share of debt, right? Minus any liabilities assumed by other partners, plus the fair market of services, the fair market value of services you provide, assuming you get the right type of ownership interests. That's great. There we go, right? Now this should be more like that. This would be like, right, immediately after you contributed it, we can tell you, like your property and you got your ownership interest, we can tell you your initial basis. Then as time passes, right, we have to update your initial basis for changes in what's going on in the business, right? It's kind of like, and it's very similar to the equity method in accounting. If you remember, like financial accounting, the equity method, if the stock goes up or the business goes up, your ownership goes up. It's like the ebbs and flows, the ups and downs. When we're talking about, our adjusted basis, we're talking about our adjusted outside basis. It's going to be our initial basis plus any new contributions we made, plus or minus any liability assumptions or debt allocations, whether the partners are taking it on or we're taking it on, plus our percentage of income minus our percentage of loss minus our distributions gives us our ending basis. Both of these are going to be our outside basis, right? Again, why we care about it is going to be if we sell our property interest, right? We need to know at any given time if we sell our property interest, we know it's amount realized minus adjusted basis. The amount realized is easy to figure out, right? It's whatever they paid us for it. The adjusted basis, this is a little bit more difficult to figure out. If and when it was right after we got our partnership interest, it would be our initial basis. If it was at a later time, it would be, our ending basis over here, basically our adjusted or updated outside basis. And you can think of this almost like a retained earnings roll forward. Every year you have to do this, right? You have to keep a record constantly of your basis. You have to track your basis as you go. So this right here is showing, kind of that base acronym with some more specifics to it. I'm going to highlight the pluses here with yellow and the minuses here with a blue. So it's kind of just showing a fancy version of this guy right here. Right, we have our pluses and our minuses. So when we look at it here, it would be like imagining you start with your initial basis here. Starting with that, you then would add these items and subtract that to get you to your ending. So any contributions you made to the partnership, that's this right here, right? Any contributions, your share of income, right? That's this guy right here. It could be, same thing with your share of income there. It's your ordinary business income and your separately stated items. Then it would be any distributions, right? You'd back those out. Any distributions, any deductions, and then any expenses associated with it. So this is kind of a fancier way of showing it. A couple things we have to note here. This is an important point. Basis can never go below 0, right? We have to always be aware of that. Likewise, when we're talking about, let's see here, distributions, right? Generally, distributions are going to reduce your basis, right? It's not going to be income to you. So let's look at 21 and 22 here. So 21 is just showing, and you can look at the facts over here if you specifically wanted to see it. Can you do a basis calc for us? Looks like our beginning basis was this. We added our percentage of income, subtracted our percentage of losses. Gives us our ending or our adjusted outside basis. Next thing it says here, right? It says, suppose a partner sells their partnership interest, but they forget to include their share of short-term capital gains in computing the basis. So in other words, suppose they screw up in here in their additions, right? They fail to include some short-term capital gains. What's the implication of this with it? And the point that's going on here, they're trying to emphasize here is why we do these adjustments is to avoid double taxation. In other words, if we fail to do the adjustment for the short-term capital gains, we do this screw up right here, then we as a partner are going to be double taxed on them. Once we're going to be taxed, at our individual level on the short-term capital gains, and then once at our when we sell our partnership interests, right? When we do the AR minus AB, right? Our adjusted basis here is going to be understated, which means that we're going to have an overstated gain. In other words, the AB is too low, meaning the gain is too high. And to the extent it's too high, right, it's going to be the amount that it should have been for the taxation for it, for the short-term capital gains. So that's the idea, right? Why we update our basis is to avoid double taxation. 2022 here is just showing us that basis can't fall below 0. So if when doing this calculation, beginning plus addition minus subtractions equals ending, you can see here, right, technically we're at like a negative $5,000 amount. However, right, basis can't fall below 0. So if somebody came up to you and they said, in light of this information, can you please tell me what the outside basis would be? Is you would say, even though it calculates the negative 5,000, it's really going to be 0 because we can't go below 0 for our outside basis. The next thing here with distributions, what are these, right? These are essentially just cash payments made to you, or it could be property, whatever the case is. It's something is pushed out to you from the partnership, right? I'm an owner in a partnership and we're going to make a distribution to you. Generally, all these are going to do, the distributions, is going to reduce your outside basis, right? It's just right there, right? It's basically the opposite of a contribution. If you contribute more, your basis is going to be bigger. If you get stuff pushed out to you, your basis is going to be smaller, right? It's kind of like if you buy Apple stock for 400 and you get 100 pushed out to you. You're not going to have a capital gain there, right? You're just going to reduce your basis by $100. In the same way, when we're doing partnership basis calculation and distributions come into play, they're generally not going to be taxable. They're just going to reduce your outside basis. However, even though your outside basis can never go below zero, as we just indicated, if you have a distribution that pushes it below zero, then in that case, the excess amount, kind of the refundable amount, once you go past zero, is going to be taxable as a capital gain. So let's just say you have an outside basis of $50. And let's say the partnership pushes out a distribution to you of $80, right? Well, we know what's going to happen here is we reduce our outside basis to zero, right? We can't go into negative, but we're going to have a $30 capital gain, right? Because our basis is 50, but you gave us something for 80. So if we look here at 2023, this just looks like, right, they're looking at a calculation of it, of the basis. There's some adjustments to it afterwards that give us some more information. Then it looks like here we have to modify our basis for the distribution, and our percentage of loss is attributed to us. It's going to get us to 130. That's great. And I have here, if the partner fails to reduce basis by the $10,000, it will make the gain bigger. So this is just showing us, right, the double taxation idea. But here's the idea that I was saying with regard to distributions and basis. Let's just say your beginning outside basis is 164, and you have a distribution of 10 and 200. Well, in this case, right, with the 164, the 10 is going to take it down to 154. There's no gain. This is just like return of capital, right? This over here in distinction is going to zero us out at the basis level, but we're going to have a gain, right? We have something worth 164, but they give us 200. That 36 is going to be a gain, right? So a capital gain. So that's the idea with 2023 here. The next thing we have to talk about, and you could have a whole course about this, this is like some complicated stuff coming up, are loss limitations, right? So the general rule I have here is partner losses from partnerships cannot be used to offset ordinary income. And generally, the best you're going to get with it is to offset other passive income. However, in order to offset other passive income, you have to clear 4 hurdles. We're going to look at 3 of them. I mean, the 4th, but in the example, we'll look at 3. So here's the idea, right? Let me kind of look at this here. With regard to any type of income loss, now this is kind of a foggy setup of it. I didn't do the best screenshot of it. With regard to any income, you're going to have 3 buckets. All right, so let's draw buckets here. Right, that you can put them into. See if I can get a line from another. Here we go. Let me just snag that. 1, 2, 3, right? Now I'm just going to put money right here, or loss, right? You can have passive, you can have portfolio, and you can have active. Any type of income, right? This is basically active is like earned income, right? It's like W-2 income. Portfolio is more like investments, right? Things like stocks, bonds. You can look at it right there. And then passive activities are basically inherently passive. And it usually includes things like K1s and rental. Those are the normal things where you get flow through and rental income. So here's the deal, right? Any type of income you get, you have to put in the appropriate bucket. Now let's say you're at $1,000 loss over here and you have $2,000 over here. What you can't do is use losses as a general rule, like very generally, right? You're not going to be able to take passive losses or portfolio losses and offset active income. That's the general rule. Now, there are exceptions to it. Any bucket, once you're in a bucket, the loss stays in the bucket. So that's going to be the general rule, right? The general rule is loss stays in the bucket. That's where you have to use it, right? Now, some of the things, right? So one of the exceptions, right? And I guess we could kind of do a thing here, would be for portfolio. Cap gains can offset, or net cap losses can offset 3K, right? That's one exception where you can take loss from here to offset active income. Another exception would be if you have a passive activity, so if you materially participate in a flow through, right, and you have a loss. So maybe you're a managing partner in a partnership. Well, in that case, it's not really a passive activity anymore. It kind of becomes an active activity. Or if, for example, this is like, you're a real estate professional. It's your full-time job. You deal with this. You're not just have like a couple rental properties where it's passive. Then you can do it. Another exception, if it's rental property, and you can have the small landlord exception, basically where you can offset up to 25K of earned income over here from rental. But don't worry about this for the exam. These are just showing you some of the weird nuances with it. The general rule, what we're focusing on, is the loss stays in the bucket. You can't cross them over. And then the best you can do is use the loss to offset other income in that bucket. So let's say over here we have passive activity 1 and passive activity 2. Let's just say it's 2 rental properties, right? One's a loser for $1,000 and maybe one's a winner for $4,000. The best you can do is offset this $4,000 by the loss. Right now, I guess it's going to have to be plus to get you to do $3,000. However, right, this isn't automatic or guaranteed. In other words, the best you can do is, you can use passive loss to offset other passive income. However, you have to jump through the hoops to do this. which we'll talk about, right? And the hoops are going to be these guys right here, the hurdles. Now, there's technically 4 hurdles that you got to go through with it, right? So this is just, again, summarizing. Passive losses can't be used to offset ordinary income, right? That's right here. Losses stay in the bucket. You can't use this loss to offset that income. The best you can do is offset other passive income. This guy right here. However, to do that, like I was saying, to offset it, to do that, you have to clear 4 hurdles. That's what this is right here. You have to jump through the hoops, right? So let's talk about the hoops here. The tax basis limitation. So a partner's outside basis limits the amount of the partnership losses the partner can use to offset other sources of income. Partners may not use partnership losses in excess of their outside basis. Any loss in excess of the outside basis is suspended and carried forward indefinitely until there's basis to use it. Okay, so we'll look at this with an example here at the end to make it make sense. But basically, the first thing with a loss is you have to clear your tax basis. Your tax basis is essentially going to be your outside basis, right? So if we look here at 2024, this is just showing us some of it with the outside basis. The next item here is the at-risk limitation, right? This is the second hoop you got to jump through. Now, really, all the at-risk rules are, when you're looking at it, all it really is outside basis, but excludes certain non-recourse debt. So it's traditionally, you're going to be your tax basis minus certain recourse debt is going to give you your at-risk amount. The third hoop here says you basically can only offset another passive activity, right? What happened in the 80s and all of this was they created these fictitious corporations that were losers financially to offset gains from other passive activities. So this can't be a tax shelter, and a passive activity is essentially one in which you do not materially participate. There's a variety of tests for this. And the idea here, as we've discussed, is you basically have to jump through the hoops. And if you make it all the way through the hoops, then and only then can you offset other passive income. The fourth hoop, which we aren't going to really include, this just says the excess business loss limitation. You can't deduct an excess business loss for the year. You have to carry them forward. It's basically a very large amount. It's going to be a threshold amount, 250 grand, plus other formulations in it. Not as concerned about that fourth one there, but I know this has been kind of vague, so let's give this some numbers, right? Let's say we have a $10,000 passive activity loss. Let's say that fourth hoop isn't in play here. And when we look at the activity itself in question, so let's just say it's a K1 from a partnership. We're not actively participating in this. It's a passive activity. We have a $4,000 tax basis. So maybe we put property in there that had $4,000. Let's assume our at-risk basis, when we adjust it for our non-recourse debt, we back that out, is going to be $3,000. And then let's assume that we have another passive activity, so a separate partnership that has $1,000 of passive income, right? So this is showing us in words what's going on here, but this is what's actually showing us what's going on. So we have a $10,000 passive loss. This is the starting point. First thing we do is we say this goes into the passive bucket, right? It's not active income. We're not a managing partner. It's not like a stock or a bond. This is like purely passive bucket. So we know the best we can do with this, according to the rules, if we go back, the best we can use is to use this to offset other passive income. It's like this right here, right? The best we could do is if we had passive income here, we could do that. But we got to jump through the hoops to do it. So the first hoop or hurdle is the tax basis. So in this partnership from which we receive a K1, we have a $4,000 tax basis. So we have a $10,000 loss flows through. Looks like 4,000 is going to clear this hurdle. You can only go up to your tax basis in it. So if 4,000 of the 10,000 clears, then that means 6,000 is suspended at that level. Okay? Then the 4,000 trickles down over here. We look to our at-risk amount, right? We have 3,000 here as our at-risk amount. Well, you can only go up to your at-risk amount. So what this means is, of the 4,000 that cleared originally, only 3,000 is going to clear the at-risk amount, meaning $1,000 is suspended at this level. If 3,000 clears, then we got to carry it over. We have another activity that generates a $1,000 passive gain, a separate partnership we receive a K1 for. Then and only then can we offset this, and we can offset it, in this case for the full amount, $1,000. But we had 3,000 clear. We used 1,000 of it, meaning 2,000 is suspended. So overall, right, if you think about it, we had a $10,000 passive loss. We know we can't use it to offset either of these two right here. The best we can do is offset that separate passive income we got. But in order to do that, we had to look at all the hoops we had to jump through. If this was something different, right, like let's say this was $8,000, well, 3,000 cleared. The best we can do here is offset 3,000 of it, right? Meaning you'd still have to report 5,000 of the gain. So even though you had a $10,000 loss, you don't get to offset all of your $8,000 gain from the separate activity. Now, with these things right here that are suspended, you can use those at a later point in time. So like next year, for example, if you have you don't have any passive losses, but you do have passive income again, you can then utilize these. Or whenever you sell the interest in the business, you can use any trapped up losses to offset the gain from it. So now this was kind of a longer lecture, but passive activity losses are pretty important, right? And this is what I have here. I said, note, we're not offsetting ordinary income, right? Instead, we're only offsetting passive income. If we wanted to offset ordinary income, we would have had to materially participate, or we could have been a real estate professional, which is basically materially participating, or we could have used the small landlord exception. But in this case, each of our passive activities were K1 flow-throughs, so it's not really going to utilize any of these, and we're truly passive. So the best we can do is, with this passive loss, is offset our other passive income after we jump through the hoops.